Welcome to TalkTickers, where your direct line, digging into the most important earnings calls.
Today, it's Autoliv. Q2 2025. They're a huge player in auto safety.
Right. And our job is to, cut through all the jargon, give you the key takeaways, performance, management thinking, what it means for the market.
All for you, the experienced investor who needs the real story fast.
Okay, let's jump in. Autoliv put up a record second quarter. Pretty resilient stuff considering, everything going on in the market.
Yeah, what's really striking is how they managed both, top line growth and better profitability, even with all those headwinds.
Okay, let's hit the key numbers. Sales were up 4% year over year.
Yep, over $2.7 billion. And the organic sales growth, that's stripping out currency but adding back tariff compensation, that was over 3%.
So solid underlying demand there.
Definitely. And that flowed through. Adjusted operating income jumped 14% to $251 million.
Which pushed the margin up, right?
Exactly, an 80 basis point improvement. So the adjusted operating margin hit 9.3%. That's pretty strong. Shows they're managing costs well. And
it wasn't just the quarter. They hit record earnings per share too. So they've more than tripled EPS in the last 5 years.
Yeah, driven by good profit growth and buying back shares, reducing the share count over time. It's a good long-term picture.
Speaking of buybacks, shareholder returns look like a big focus.
Oh, absolutely. They bought back $51 million in shares just this quarter. Took about 500,000 shares off the market.
And they want to keep that going.
Mm-hmm. They're aiming for $300 to $500 million in buybacks annually. That signals, real confidence in their cash generation.
Plus, they're bumping the dividend. Third quarter dividends going up to 85 cents a share. Another sign of confidence.
For sure. Now, cash flow. Operating cash flow was solid at $277 million.
Solid, but down from last year.
It was, yeah. They said it was mostly temporary, a buildup in receivables, basically money owed to them from strong sales, plus some tariff stuff hitting late in the quarter.
Okay, so a timing thing mostly.
Seems like it. And despite that dip, their returns are still really healthy. Return on capital employed at 24%, return on equity at 28%. They're using their capital efficiently.
All right, so that's the snapshot.
Mm-hmm.
Impressive numbers. But let's dig a bit deeper now. What's driving this operationally? What are the strategies?
Yeah, this is where it gets interesting. Because you look at those results and you have to ask, how sustainable is this? Especially the margin gains.
Right. So where did that profit improvement come from?
Well, it wasn't just luck. Management pointed directly to efficiency programs and cost control actions, things like better direct labor productivity.
And didn't they mention headcount?
They did, a reduction of 3,200 direct production staff year over year, but they linked that to their automation and digitalization push. So it's structural change, not just cuts.
Okay, so efficiency gains driving profit. You can see that in the gross margin too.
Yep. Gross margin up 30 basis points to 18.5%. And again, they tie that straight back to labor efficiency and those headcount changes. It's pretty direct.
Got it. What about working capital? You mentioned the receivables earlier.
Right. So trade working capital overall went up $185 million. Receivables were the big piece, up $251 million. Inventory is also up a bit, $21 million.
But payables were up too.
Yeah, accounts payable increased $87 million, which offsets some of it. But management sees this working capital build as temporary. They expect improvement programs and better customer call-off accuracy, basically. Customers ordering more precisely to help manage inventory better going forward.
Makes sense. And capital spending. Were they investing heavily?
Actually, no. Net CapEx decreased by $32 million. It was 4.2% of sales, down from 5.6% last year.
Why the drop?
They mentioned lower spending on their physical footprint, particularly in Europe and the Americas, and less spending on expanding capacity in Asia. Seems like they're focusing on getting more out of existing assets.
Smart. And financially, their leverage looks okay.
Very much so. Leverage ratio is strong at 1.3 times. That's well under their target ceiling of 1.5 times.
Even after returning $500 million to shareholders in the last year.
Even after that. Plus, they refinanced a SEK $3 billion loan successfully. So, the balance sheet looks quite solid.
Okay. Operations are getting leaner. Financials are stable. How are they handling the big external stuff, like the China market?
China's always complex. Overall, light vehicle production, LVP, had some weird shifts, but Autoliv actually saw a clear improvement there.
Improvement how?
Their sales growth in June actually beat the LVP growth, and the gap between their sales and LVP, it narrowed quite a bit from earlier quarters.
What caused that improvement?
Recent product launches, especially with Chinese OEMs, they're gaining share in segments where maybe they weren't as strong before, particularly, with the domestic EV makers there.
Interesting. Okay, the other big external factor, tariffs. That's got to be a headache.
Huge headache for everyone. But Autoliv seems to be navigating it pretty well, actually. They recovered about 80% of the Q2 tariff costs.
80%. How?
Through customer negotiations, mainly, but also things like adjusting shipping points, making sure they comply fully with USMCA rules, exploring other ways to get compensated.
And they expect to get the rest back.
Most of it later this year. Now, the gross tariff exposure could double, maybe hit $200 million, but the net impact on profit for 2025, they think it'll only be about a 20 basis point hit to the operating margin, mostly timing differences.
Still, 20 basis points isn't nothing, but managing it that well is pretty key.
Absolutely. It shows operational strength.
And new products, are they still launching things?
Oh, yeah. Q2 was busy, especially in Asia, China included. New models coming out with Autoliv content anywhere from, say, $100 up to over $500 per vehicle.
What drives the higher content?
Things like front center airbags, those are adding value. And interestingly, they launched seatbelts on a couple of key small Japanese cars. That expands their reach in that important segment.
Good diversification. What about pricing generally? Inflation's still a factor.
They're still negotiating, especially on tariffs, as we said. Inflation isn't the huge wave it was a couple of years ago, but it's still running higher than normal.
And the usual OEM price pressure.
That's still there. For existing programs, the expectation is still that suppliers give back, maybe 4% per year. That's just part of the auto business. Constant negotiation.
Right. And quickly, currency. Big impact or no?
It was actually a positive $12 million effect in Q2, mostly from revaluations. Some pairs like Mexican peso USD were favorable, others less so. But for the full year, they expect the net translation effect on sales to be basically zero.
Okay, so not a major story for the full year, it seems.
Doesn't look like it right now.
All right, let's step back. We've got the numbers, the operations, the external factors. Yeah. What does this all mean for you, the investor listening in? How does Autoliv stack up against the broader trends?
Yeah, and maybe the bigger question is, they've shown this resilience, right? But how does that translate into a sustained competitive edge as the whole industry keeps shifting?
That's the key question. Because the overall market, especially LVP light vehicle production, it looks pretty mixed.
Very mixed. Stark differences region by region. North America's outlook, for example, got downgraded significantly.
Why that?
Trade risks, higher prices from import tariffs. S&P Global is specifically calling out potential hits to vehicles made in Mexico and Canada, especially later in the year, Q4.
But Europe is okay.
Europe did better than expected in the first half, but the outlook for the second half hasn't really changed. They expect automakers to pull back a bit to reduce inventories.
And China?
China keeps growing. Government policies there are really pushing new energy vehicles, EVs, and they've relaxed some auto loan rules. That's helping.
What about Japan and Korea?
They could see declines mainly because of potentially lower exports to the U.S., tying back to those trade concerns. So yeah, it's a really fragmented picture globally.
One positive sign you mentioned earlier was call-off volatility improving.
Right. Year over year, and even from Q1, customers seem to be ordering with a bit more stability. That's good news for suppliers. Like Autoliv makes planning easier, more efficient.
But the OEM price pressure remains.
Always. That discussion around terms and conditions, it's just a constant back and forth, part of doing business in this sector.
What about the EV transition? Does that help or hurt Autoliv?
Well, interestingly, Autoliv says their market share and their content per vehicle are pretty similar, whether it's an EV or a traditional combustion engine car.
So they're somewhat powertrain agnostic.
It seems that way, yeah. Their safety products, airbags, seatbelts are needed regardless. They said EVs haven't really hurt their positions, certainly not in the Americas.
Okay, but there was one potentially negative trend. Something about launches.
Yeah, launch delays. They noted that RFQ's request for quotes for new car models are getting pushed out.
Because of tariffs and uncertainty?
Exactly. So automakers are keeping existing models running longer. It reflects a kind of broader caution across the industry about making big new investments right now that could slow down future growth pipelines for suppliers if it continues.
So given all that context, how is Autoliv positioning itself strategically?
Their focus seems clear. deepen partnerships with the big global OEMs, but also, critically, with those leading Chinese automakers, really cement their market leadership.
And keep innovating.
Absolutely. Keep pushing on the core stuff, airbags, seatbelts, steering wheels, but also developing new safety solutions for, future mobility concepts. That taps into global growth, rising safety standards.
Plus the operational stuff we talked about, efficiency, automation, footprint.
Right. All that operational excellence work is fundamental to their profitability improvements. It's not just about sales, it's about how they make those sales profitable.
And underpinning it all is that commitment to shareholder returns, the buybacks, the dividend, keeping leverage low.
Yeah, that sends a strong message about financial stability and their focus on creating long-term value.
Okay, now let's pivot to our this is not financial advice segment, just a thought-provoking idea, remember, not a recommendation.
Exactly. Purely hypothetical food for thought. But given everything we've just discussed about Autoliv's resilience, here's a potentially outrageous but maybe plausible trade idea.
All right, let's hear it.
How about a pair trade? Long Autoliv, ticker ALIV, and short, a North American-focused OEM, specifically one with significant production in Mexico or Canada.
Okay. Walk us through the thinking there.
Well, Autoliv just showed they can recover, 80% of tariff costs and expect to get most of the rest. They've got a diversified footprint, including plants in the U.S., like in Utah. That helps mitigate USMCA risks.
Right, they seem well-positioned to handle the tariffs.
Exactly. But at the same time, S&P Global is downgrading North American LVP precisely because of those tariffs and trade risks, hitting Mexico-Canada production hardest, especially in Q4.
So you're betting Autoliv navigates this better than the OEMs directly exposed.
That's the core idea. The play is on Autoliv's operational agility and their tariff mitigation compared to OEMs facing potential demand hits and higher costs from those same tariffs.
While the OEM struggles with lower production and tariff burdens,
Autoliv, as the crucial safety supplier with these cost recovery mechanisms, might be more insulated, maybe even relatively stronger. So, long the resilient supplier, short the directly exposed OEM.
interesting contrast. Definitely food for thought.
Just an idea.
All right, so that wraps up our deep dive into Autoliv's Q2 2025 call. Pretty clear picture. Record results, strong operations, navigating tariffs surprisingly well.
Yeah, even with a pretty challenging outlook for the second half, especially on the LVP front.
Their focus seems to be on those structural cost cuts, innovation, and definitely returning cash to shareholders. That looks like a solid foundation.
For sure. The big question mark remains, how well they continue to manage the tariff situation as it evolves and how those regional LVP shifts play out. Agility is key.
Well, we hope this breakdown gave you some valuable insights, some actionable knowledge maybe. But remember, as always, this is for educational purposes.
Definitely not financial advice, but hopefully it gives you some things to think about for your own investment thesis, especially around the auto supply chain and those regional dynamics.
Absolutely. Until next time, keep digging, keep learning.
And stay well informed.